gold began competing with the Fed's all-hallowed treasuries. That's where the problem lays. This competing safe haven gold demand began the process of disconnecting this relied-upon, programmed inverse algorithm that has enabled, this mindless algorithm that has enabled over 50 years of Comex gold price management against the dollar. Now, this is the issue here. The fact that gold now competes with treasuries undermines the 1913 Federal Reserve Act. All of this aside, there's only one question we need to ask ourselves. How much physical do we own?
Gold continues to trade at a premium to real bond yields, in part due to the Israel-Hamas war, suggesting downside risks in the near term. However, high government debt will lead to lower real interest rates, which should be highly bullish for gold in the long term. AndrewMaguire, independent London metals trader and analyst, predicts gold began competing with the Fed's all-hallowed treasuries. That's where the problem arises. This competing safe haven gold demand began the process of disconnecting this relied-upon programmed inverse algorithm. That has enabled over 50 years of Comex gold price management against the dollar. The federal debt is $33.7 trillion. Just a 1% increase in yields adds $337 billion to the annual cost of servicing the debt over time, as more of the debt is rolled over at higher interest rates. That adds to the Biden administration's already large deficits, so that higher interest costs grow the debt even faster. The Treasury is already spending an annualized $1 trillion to service the debt. The Treasury Department recently dropped a financial bomb, announcing the deficit for fiscal year 2023 was $1.7 trillion. The Treasury just released new numbers projecting borrowing of $1.6 trillion in just the first half of fiscal year 2024. We will now bring you clips from Andrew's recent interview with Shane Moran, appearing in Live from the Vault. Please watch, share, and like this video, as Andrew drops a very good question. Who's left to buy the $1.74 trillion of newly issued treasuries next year? Also, ensure you subscribe to the channel and turn on the notifications so you will never miss our uploads. Thanks, and enjoy the video.
Geopolitical drivers are assistive, obviously, in driving safe haven gold demand. But the underlying inputs that are really driving a strong bid into gold are far wider and really impossible to ignore. Now, following a record upsurge in US Treasury supply, US debt has exploded higher by over $1 trillion in just 3 months. And that prompted Goldman to question, and their question was, who's left to buy the $1.784 trillion of newly issued treasuries next year? That's a good question, considering that to incentivize the uptake of this fresh issuance, the interest on this debt would have to rise exponentially higher to the point that it becomes the single biggest government outlay. Now, ultimately leading to just one conclusion, and there can only be one conclusion, to re-implement quantitative easing so as to monetize the debt and the deficit. And this previously unfactored US Treasury tail risk is increasingly weighing on Treasury demand. And that is completely contra to Yellen's assertion that higher bond yields reflect a healthy US economy. And really, at the margin, this lack of Treasury uptake is a driver that is actually spiking bond yields higher. Investors actually seek real asset alternatives, really largely evidenced by investors moving into safe havens, which include cash and gold. Speculators are not really in there chasing the price higher. And some of what the speculators have bought is sticky. Instead, liquidity providers report this gold demand is being driven by very tight physical supply into very strong physical demand. Now, these supply imbalances are forcing the offer to sell bullion into the marketplace to rise in prices accordingly. And while this is not so evident in the increasingly illiquid local London fixing process, which does not come close to reflecting the real gold price determined by the increasingly liquid physical exchanges such as Moscow, the SGE, where global south prices are actually being discovered. nor do these local London fixes reflect the non-disclosed central bank monetary gold purchases. And even though we just seen the World Gold Council talk about record central bank gold demand, none of that is captured in the monetary gold inflows. And we'll look at that shortly. But the problem the Fed faces is that each round of T+2, in other words, when something becomes deliverable in London, it has to be 2 days deliverable under Basel III NSFR rules. So this T+2 deliverable spot market milestone, the Fed is facing another milestone. And this is being developed. This is actually being evidenced in the 10 times larger NSFR compliant delivery markets, such as we saw it at 1800, 1850, 1900, 1950, and now the fight at 2000. And while we fully expect a fight, an initial pushback at every round number, ultimately, it triggers fresh weighting layers of sidelined central bank sovereign bid levels. They tend to aggregate at those round numbers, whether it be a 1800, 1850, or a round number could also be at halfway between the two big round numbers.
The Federal Reserve said Wednesday it will pause its rate hikes, keeping its benchmark lending rate at a 22-year high while signaling fewer rate cuts next year. The Fed's latest set of economic projections showed that more officials expect the Fed's key lending rate to top out at a range of 5.63 to 5.87% this year, meaning there could likely be another rate hike by year's end. Officials revised their expectation of economic growth this year much higher, and their projection of the unemployment rate slightly lower. Notably, officials expect fewer rate cuts in 2024 than previously estimated, confirming investors' fears that interest rates could remain higher for longer. However, Andrew noticed that the Global South dumps treasuries for gold bond yields are seen to be rising alongside gold and the dollar. That's confusing for a lot of mainstream analysts, and while gold is not really on the mainstream analysts' radar.
And central banks are aware that gold is severely undervalued versus debt assets and will continue to draw down supplies at any price, in turn driving the offer price to sell gold steadily higher. In short, as the Global South dumps treasuries for gold, bond yields are seen to be rising alongside gold and the dollar. While gold is not really on the mainstream analyst radar, bar for some very recent turnaround, it's amusing to actually see them racing from pillar to post, trying to rationalize how spiking bond yields will impact the neutered Fed as they fly blind into a debt hurricane. And today we've got FOMC, it'll be a non-event. Yes, it's going to be a hawkish pause. I mean, anything to try and spin the yarn out, and to not lose faith. But really, if the Fed keeps adding more paper gold supply, it's be like pushing on a string with the reciprocal end of the string firmly in the hands of competing central banks. And the snookered Fed knows it. And they must by now be gearing up for a gold market revaluation next year. There is no other solution. QE. And as we exit 2023 trading, we are privileged to be witnessing the inflection point where Nixon's temporary suspension of the dollar's convertibility into gold some 52 odd years ago has been reversed. And as it is right now, every single market-making liquidity provider privileged to have a foot in both markets, they must physically back their spot market positions. These guys also run a leveraged Comex trading book, and we talked about that. So, which has been very, very profitable. But in excess of what they may naturally hedge one-to-one for their own book, they also gain alpha by running this leveraged paper settled Comex trading book against speculators. But this is limited to how many speculator takers there actually are for each of those offerings. And any excess paper supply simply will be backdoored and expose the officials to delivery of gold that will have to be actually bought at market. And while the agent banks run the Fed's book, they are never short for their own house accounts. Now, these official agent liquidity providers appear in the various categories of the COT report, which is the only report really that comes out of the out of the casino, basically. And it's always incredibly delayed. But our primary focus is on really out of that report. Our focus is on the predatory swap dealer category. And that is the agent banks populated by the likes of JP Morgan, HSBC, Citi, Bank of America, and a few others. Interestingly, though, not by Goldman Sachs, who, aside from taking their own book, obviously these other traders, also act as these are the agents that act for the Fed. And as insiders, of course, they greatly profit from this relationship. Look, we just saw this. We're recording this on Wednesday. We just saw this again yesterday after this cartel waited for the London fix to settle just before they raced to square end of month what we call trade at settlement derivative bets, exactly at the COT cutoff point. These are the two reported every Tuesday. There's a COT cutoff point. This was an end of month as well. This was a derivative squaring moment. That's why we saw that gamed dip. Now, it has just become so obvious. And utilizing insider information such as news leaks ahead of a major news event, such as non-farm payrolls, FOMC today, etc. As we can see again, these banks are able to coattail these official whale-sized transactions, but for their own personal book, they, like any good pit manager operating a 95% win book, limit the house exposure by never exceeding leverage that cannot be laid off on the speculators, relied upon to never stand for physical delivery.
Gold prices exploited the weaker-than-expected non-farm payrolls, NFP report last week Friday, that showed a higher unemployment rate and lower wage growth, a key contributor to inflationary pressures in the U.S. Although one release does not make a trend, this may be the beginning of a weaker jobs market within the region. The Federal Reserve would welcome such data in an environment where tight monetary policy conditions have heightened recent recessionary and stagflation concerns. The known-on effect on financial markets saw a drastic decline in U.S. Treasury yields, thus translating through to a fall in real yields. See graphic below. Overall, gold's attractiveness has increased, considering the opportunity cost of holding gold has decreased. Money markets have shifted their interest rate expectations for the Fed by roughly 90 basis points from just a few weeks ago in terms of cumulative rate hikes by December 2024, 152 basis points, with the first cut projected around May or June as opposed to July. From a geopolitical standpoint, the war between Israel-Hamas remains volatile and will continue to support gold prices due to its safe haven allure. While the war is relatively contained at this point, any escalation could stoke contagion fears, ultimately driving up the price of gold. What are your thoughts on Andy's interview? Do you agree that safe haven gold demand disrupts the Fed's risky $1.784 trillion lifeline? Please drop your comments in the comments section below. Also, ensure you like this video, subscribe to the channel, and check out our other videos on gold, silver, and other commodities. Thanks for watching.